Welcome. If you're listening to this, you're looking to crush your ACCA BT1 exam, and more importantly, you want to dodge the examiner's traps. Today's explainer? It's all about bagging those easy foundational marks. We're stripping away the textbook fluff and zeroing in on just 4 words: capital, revenue, expense, and profit. Let's get right into it. Now, I can almost hear some of you sighing, thinking, capital, revenue, expense, profit? Seriously? We learned this on day 1. But look, here is the brutal truth. Being overconfident with these absolute basics is exactly where the examiner gets you. They're banking on the fact that you'll just skim a question, assume you've got it, and click the wrong box. Well, not on our watch.
So here is our game plan for today's explainer. 1. The foundational 4. 2. Capital, the owner's claim. 3. Revenue and expense. 4. Profit, the ultimate metric. And 5. Dodging the exam traps.
All right, section 1, the foundational 4. Let's master the basics. Our very first pillar is capital. By definition, capital is simply the owner's investment in the business. It represents the owner's claim. Now, I need you to mentally highlight this. Capital is the owner's money. It's completely internal. It is absolutely unequivocally not a liability owed to some external party, like a bank or a supplier. And honestly, this is the classic trap students fall right into year after year. Picture this. A scenario describes money being injected into the business. You panic. You click liability to external parties. When in reality, it was just the owner putting in cash. Boom. You lose the mark. Listen, the correct answer every single time the owner invests is capital. So your absolute golden rule to take away here. Capital equals owner's funds. Say it out loud. Write it on a sticky note, do whatever you need to do. When you're sitting in that exam hall and you spot the phrase owner's investment, your brain should immediately scream capital. No second guessing. Moving on to section 2, revenue and expense. Let's get operations decoded. First up in the day-to-day operations, we have revenue. The strict definition here is income earned from normal business activities. Think your everyday sales or your regular service income. And I really want you to fixate on that exact phrase, normal business activities. We aren't talking about a one-off sale of your old factory building here. It's the routine, daily grind of selling whatever your core product or service is. Which brings us to another massive exam trap. The examiner absolutely loves to play vocabulary games with you. They'll throw in the phrase income from operations. And a stressed-out student, well, they might freeze, wondering if that's some weird, special category of profit. Guys, it's not. Income from operations literally just means revenue. Wire those two phrases together in your brain permanently. Now, on the flip side of the coin, we've got expense. An expense is simply the cost incurred specifically to generate that revenue we were just talking about. It's the necessary sacrifice, right? You literally cannot make sales without paying your staff. So things like your salary payout, the monthly rent, the electricity bill, these are the unavoidable costs of running the show. They are your expenses. Okay, pay really close attention here because this comparison is tested all the time. Say you buy a brand new heavy-duty machine. That money spent to acquire an asset, that's a cost. But when you use electricity to actually run that machine on a Tuesday, that's a cost consumed in daily operations. That is an expense. The golden rule to remember: a cost only becomes an expense when it's actually used. To sum that up, here are the 3 rules you need to lock in right now. First up, revenue equals income earned. Second, expense equals the cost of earning that revenue. And third, a cost becomes an expense when used. Memorize these and you'll be knocking out related multiple choice questions in under 10 seconds flat. Seriously. All right, section 3, profit, the ultimate metric, calculating performance. Here it is, the golden equation of business performance. Profit equals revenue minus expenses. It is the ultimate, undeniable indicator of how well your business is actually doing. It simply means what you've earned after all your costs have been stripped away. At the end of the day, it's the one metric every single shareholder is looking at. Section 4, dodging the exam traps. The cash versus profit illusion. There is a really sharp contrast here that you absolutely have to grasp. Profit is an accounting concept. It's built entirely on accruals and matching principles. Cash, on the other hand, is actual, physical money sitting in the bank. I need you to hear me loud and clear on this. Profit does not equal cash. Mixing these two up in the exam is basically a fatal error. Let's just walk through a quick scenario to prove exactly why this happens. Step 1. You make a huge sale to a customer, but you do it on credit. Step 2. Because you made that sale and technically earned the revenue, your profit goes up immediately based on standard accounting rules. But Step 3. Because it was a credit sale, the actual cash hasn't been received yet. So your profit just spiked, but your bank balance? Still completely flat. So hammer this single sentence into your memory right now. Profit is accounting, cash is reality. If you ever come across a scenario where profit is earned but there's no cash to show for it, instantly recognize it as a credit sale or just a timing difference. Please never ever fall for the profit equals cash trap. And finally, Section 5, dodging the exam traps. Let's do a rapid-fire review. Let's lock these 4 triggers into your memory before we wrap up. Ready? Capital, owner funds, revenue, income earned, expense, cost to earn revenue. Profit, revenue minus expense. This right here is your ultimate defense shield against the examiner's tricks. When you see the concept, I want you to just fire the trigger. So, you know the definitions now, but the real test is spotting the traps under the ticking clock of the exam. Remember, capital is never a liability. A cost is not an expense until it's actually used. And profit? Definitely not cash. Master these, and those marks are basically yours. But before you go, it begs a much larger question for you to ponder. If profit really doesn't equal cash, how long can a highly profitable business survive if its bank account is entirely empty? Good luck studying.